You log into your banking app. The Face ID does its little spin, and there it is, the number. Maybe it is $20,000. Maybe it is $80,000. You stare at that checking or savings balance, and you feel, safe, right? You feel responsible. You look at your friends financing depreciating cars they can't afford, and you think, well, at least I have a massive pile of cash sitting right there, ready for anything. I hate to break this to you, but you are bleeding out. That pile of cash, it is actively evaporating while you sleep. And the craziest part is that you are doing it to yourself voluntarily because you think it is the smart thing to do. Most people think a massive bank balance is the ultimate financial shield, but the math proves it's actually a slow-motion financial suicide. You see, society conditioned us to save money. Your grandparents put cash under the mattress. Your parents told you to build up a huge savings account for a rainy day. But the economic rules changed, and nobody bothered to send you the memo, which is, exactly why we're sitting here today. I'm Bank, and we need to have a very uncomfortable conversation about your money. Today, we're going to calculate the exact dollar amount you should have in your bank, not a guess, an exact formula. Because anything past that specific number is dead weight. It is burning your future. By the end of this, you are going to know exactly how much to keep, where the rest of it needs to go, and how to stop inflation from secretly picking your pocket every single day. Let's get into the ugly reality of the high score illusion. I get it, I really do. Logging in and seeing a fat 5-figure or 6-figure number in a checking account hits your brain with a massive dopamine spike. It's a high score. It proves you survived the month, the year, the layoffs. But here's the problem with your high score. Banks are basically just a parking lot. And right now, you are paying a massive daily fee to park a Ferrari in a dirt lot. We suffer from this cognitive bias where we only trust what we can see. You see $50,000 on a screen. Tomorrow, it still says $50,000. Next year, it says $50,000. Your brain goes, awesome, I didn't lose anything. Except you did. You lost purchasing power. Inflation is the silent tax on financial cowardice. Let's say inflation is running at a totally average, totally normal 3%. Which is honestly being generous given the last few years. If you leave $50,000 in a bank account earning 0.01%, that money is losing $1,500 of buying power every single 12 months. You didn't spend it, you didn't buy a terrible stock, you just sat there, and the economy effectively reached into your account, took out $1,500 and set it on fire. And you smiled because the screen still said 50 grand. This is the second biggest mistake you are making. You are confusing a static number with static value. A dollar is only worth what it can buy. If a carton of eggs goes up by 30%, your bank balance just effectively dropped by 30% in the grocery aisle. But that is just the surface. That is just what you are losing to inflation. Wait until we look at what you are losing in opportunity. That is where the math gets genuinely violent. All right, let's put feelings away and look at the numbers, because math does not care about your anxiety. Let's say your living expenses are $4,000 a month, but because you are terrified of going broke, you keep $60,000 sitting in a regular checking or basic savings account. You tell yourself it's for emergencies. Okay, let's keep a true emergency fund of, say, $15,000. That's nearly 4 months of expenses, more than enough to fix a car, cover a medical deductible, or survive a job hunt. That leaves $45,000 of excess cash. Cash that is just sitting there, getting dusty. What if you took that $45,000 and actually put it to work? What if you invested it in a basic, boring S&P 500 index fund instead of letting the bank use it to get rich? Historically, the market returns about 7 to 8% per year adjusted for inflation. But let's be conservative. Let's just say 7%. If you invest that $45,000 and never add another single dime to it, you just let it sit there for 20 years. Any guesses? That $45,000 turns into $174,135. Read that again. $174,135. If you leave it in your bank account, after 20 years of 3% inflation, the purchasing power of that $45,000, what it can actually buy in the real world, drops to about $24,000. So, by keeping your money safe in the bank, you didn't just lose money to inflation, you missed out on roughly $130,000 of free compounding wealth. That is the cost of your comfort zone. You are literally paying over $100,000 just for the privilege of looking at a big number on your phone when you are bored. It is insane when you map it out. We work 40, 50, 60 hours a week to earn money, and then we give our money the rest of its life off. Your money should be working harder than you are. Period. So, what is the actual number? How much should you hold? The golden rule, the absolute ceiling for pure cash in a bank account, is 3 to 6 months of absolute bare bones living expenses. Notice I said bare bones. I don't mean 6 months of your current luxury lifestyle. I mean survival mode. Rent or mortgage, groceries, utilities, insurance, minimum debt payments. That is it. No dining out budget, no vacation fund. If your survival number is $3,500 a month, your maximum bank balance should be $21,000. And honestly, if you have a highly stable job, a dual income household, or highly liquid investments, 3 months is plenty. That is $10,500. Anything over that amount is dead money. But Heisenbank, you say, what if I need a new roof? What if my transmission explodes? What if the economy collapses? Look, I get it. But your emergency fund is a paramedic, not a long-term care facility. It is there to stop the bleeding in an immediate crisis. It is not designed to fund your life for the next 2 years. If you lose your job and remain unemployed for over 6 months, you are going to be making structural changes to your life anyway. You will be selling assets, downsizing, cutting costs. Having 2 years of cash sitting in a bank account just in case is like wearing a bulletproof vest in the shower. Sure, you are protected, but you look ridiculous, and it is ruining the whole experience. Look, if looking at this math is making you physically uncomfortable, if you are realizing you have been burning thousands of dollars a year in lost opportunity, hit the subscribe button. We don't sugarcoat things here on Breaking Finance. We fix financial sickness with raw numbers. Subscribe and let's get your money working. So why do we do it? Why do smart, capable people leave $80,000 in a checking account yielding nothing? It is fear, plain and simple. We are dealing with financial PTSD. A lot of you watched your parents struggle during the 2008 recession. You saw people lose their homes. Or maybe you went through the panic of 2020 and saw whole industries just shut down overnight. Your brain internalized a very specific lesson. Cash is oxygen. Without it, you die. So you hoard it. Behavioral psychology calls this loss aversion. We actually feel the pain of losing $100 roughly twice as intensely as the joy of gaining $100. Investing feels like putting your money at risk. The market goes down 2% on a Tuesday, and your stomach drops. You feel like you are losing your security. So you retreat to the bank account, because the bank account never has a red day. But I need you to completely rewire how you view risk. Putting all your excess money in the stock market or real estate feels risky in the short term because the prices bounce around. But over a 10, 20, or 30-year horizon, investing is actually the safest thing you can do to guarantee your wealth grows faster than prices rise. Leaving your money in cash feels safe in the short term because the nominal number never drops. But over a 10 or 20-year horizon, holding cash is a guaranteed 100% certainty of loss. You are trading short-term emotional comfort for long-term financial poverty. Let's look at what the wealthy actually do. If you look at the balance sheet of an ultra-high net worth individual, they are notoriously cash poor, proportionally. If a guy is worth $10 million, he does not have $2 million sitting in a Chase checking account. Why? Because banks use your deposits to make themselves rich. When you deposit $50,000, the bank does not put it in a little vault with your name on it. They immediately turn around and lend your money to someone else for a mortgage at 7% or a credit card at 24%. They are making massive returns on your capital, and they pay you 0.01% as a thank you. The wealthy refuse to play this game. They keep their liquidity in cash equivalents that actually pay them: short-term treasury bills, high-yield savings accounts, money market funds. If you absolutely psychologically cannot stomach putting your excess cash into the stock market right now, you at least need to move it into an account that pays a yield close to inflation. If you have $50,000 and you move it from a big traditional bank to a high-yield savings account paying 4.5%, you literally just gave yourself a $2,250 raise this year for clicking a few buttons. And for the highly successful people watching this, holding extreme amounts of cash, anything over $250,000 at a single institution is literally unprotected. The FDIC only insures up to $250,000 per depositor per bank. If your bank goes under and you had $400,000 sitting in a single account, kiss that extra $150,000 goodbye. It is gone. You are an unsecured creditor now. Get in line. All right, let's fix this today. You watch the video, you know you have too much cash, you know the math is working against you, but if I tell you to take $40,000 out of your checking account tomorrow and dump it into an index fund, you are going to have a panic attack and do nothing. Paralysis by analysis. So we do it systematically. We use logic to hack your psychology. Step 1. Calculate your exact 4-month survival number. Write it down. Let's say it is $12,000. Step 2. Open a high-yield savings account at a different institution than your daily checking account. Move the $12,000 there. It takes 3 days to clear back to your checking if an emergency happens, which prevents you from spending it impulsively, but it still earns 4 to 5%. Step 3. Take the rest of your massive cash hoard, the excess, and divide it by 6. If you have $30,000 of dead money left over, dividing it by 6 gives you $5,000. For the next 6 months, you are going to dollar cost average into the market. Every month, on the same day, you move $5,000 from your dead checking account into a brokerage account, and you buy a broad market index fund, VOO, SPY, VTI, whatever broad ETF you prefer. By spreading it out over 6 months, you eliminate the fear of buying at the top. If the market drops next month, great, your next $5,000 buys in at a discount. If it goes up, great, your first batch is already making money. You slowly bleed down your cash pile into an automated wealth-building machine. No panic, just systematic execution. Listen to me carefully. Your bank is a tool. It is a waiting room for your money before it goes out to do its actual job. It is not a vault. It is not a sanctuary. Every time you log into that app and feel pride at seeing a massive, stagnant number, I want you to replace that pride with a mild sense of urgency, because a lazy dollar is a dying dollar. We have to shift our mindset from survival mode to empowerment. Survival mode tells you to dig a hole and bury your resources. Empowerment tells you to plant those resources like seeds so they grow into an orchard that feeds you forever. Stop playing defense with 100% of your net worth. You cannot shrink your way to wealth. You have to allocate. You have to risk intelligently. To wrap this up, I want to leave you with a quote from the author Robert G. Allen that completely shattered my perspective on cash years ago. He said, "How many millionaires do you know who have become wealthy by investing in savings accounts?" I rest my case. Take your money off the sidelines. Put it in the game. I am Heisenbank. See you on the next one.